Do you speak crowd lending? Welcome to our podcast covering the crowd lending industry. Our mission is to provide you with all the insights from this market and help you make informed decisions. I'm Gassan, co-founder and CEO of Acredius. We are a crowd lending platform based in Zurich, Switzerland. I'm delighted to host this podcast and hopefully bring value to all our listeners.
Hi, everyone, and welcome to the episode 19 of the Do You Speak Crowd Lending podcast. I'm very honored today to have a special guest from Paris, Erich Bonnet. Erich is the CEO at Smart Lenders Asset Management. Smart Lenders Asset Management is a trusted institutional partner providing a secured and sophisticated access to online marketplace lending investments. Welcome, Erich.
Thanks. Hi, Gassan.
Thank you, Erich. Thank you for being with us today. I did a little intro about you, but I'm more than happy to hear from you. Who is Erich? How was the journey so far with Smart Lenders?
Of course. My background is trading and asset management. I started my career as market maker in interest rate derivatives in a French bank, and also founded my company. Of course, we were backed by a financial institution dedicated to market making. So I both worked on OTC markets and on the floor. Floor trading doesn't exist anymore, but believe me, it's a very good school for trading and humility. And in 1998, I founded ADI, an alternative asset management boutique, which had an AUM of 6.5 billion euros in 2007. ADIs was specialized in arbitrage strategies like convertible bonds or credit arbitrage. And after the sale of the company in 2007 and 2008, I retired and focused myself on niche investments with my personal holding company and friends' money. And this is how I met in 2012 through a common friend, Renaud Laplanche. And as you know, Renaud Laplanche is a French founder of Lending Club. And I heard for the first time the word marketplace or peer-to-peer lending. And I was really amazed. And in 2014, I felt that this was really a very attractive asset class for European investors, and decided to launch Smart Lenders Asset Management to become one of the leading specialists to get access to this asset class for European investors. Today, we are a team of 12 managing one single fund. We are about to launch a new fund, and we may discuss that later on. And our AUM is $410 million US, which makes us one of the biggest or the largest fund in this area in Europe.
Impressive. Congrats on that.
Thanks.
And I know that you guys just reached a big milestone in June 2021. Can you tell us more about it?
Yes, this big milestone is we've been lending since the start of the company $1 billion US, so roughly 140,000 loans.
Wow,
that's very significant. This shows how experienced we are on this asset class, and especially on the US market. So it's a symbolic and big achievement. And we had during the last 7 years to constantly adapt our investment process, find new platforms, new niches, new markets. And we currently invest between 25 and 50 million a month, depending on the inflows that we do have.
Wow.
So these are significant amounts.
You are very humble in saying that. Yes, these are significant amounts. Great achievements. Congrats again. Can you tell us more about the returns?
Yes, of course. We launched Milestone, our flagship fund, in July 2016. So we now have a 5-year and almost a half track record. And IRR since the launch of the fund has been 6.37% in US dollar and 4.34% in euro. Of course, we do hedge the US dollar exposure, and this means that we have this difference in yield between the two share classes. We only had one negative month, but what negative months? we were down 5% in March last year, so that's very significant, in particular with a fund which has our target return is 6% yearly. And of course, we do not have any leverage. It's important to mention that. And that's it. But it's an asset class which is not so very difficult to time, because the best entry point is at the beginning of a new economic cycle. Now, for example, as rates are still high and delinquencies, defaults decreasing rapidly, thanks to the surge in employment, salaries, business activity. Alongside, the business cycle returns will decrease slowly because of lower lending rates and slightly increasing defaults. And at the end of the business cycles, and we saw that in 2018, 2019, even if no one imagined what would happen with the COVID crisis, of course, but we saw that rates started to increase, and of course also underwriting criteria to be more strict. And when the economy is back into a recession, this is where we should have much lower return, even negative returns. And this is clearly the beta of the asset class. So what happened last year was simply amazing, because as the Fed and the Trump administration bailed out the economy, including the consumer, defaults that should have happened and hurt our performance simply didn't happen. So therefore, we did well last year, even with the March drawdown. So I'm not sure that it will be the case for the next recession, but at least we benefited from that last year.
Interesting. And with the current fund, well, in what kind of vertical are you investing? Is it more consumer, business, real estate?
We are 90% of our AUM is invested in consumer loans in the US.
Okay.
2% in consumer loans in Europe, only through one channel, buy now, pay later in France.
Okay.
And 8% in small business loans, both in the US and Europe. So, of course, our big exposure is on the US consumer.
I see.
The explanation is simple. As I mentioned, if we need to invest between 25 and 50 million a month, this is very complicated in most of the verticals in this market, except the US consumer.
Yeah.
And furthermore, the risk return on the US consumer is very attractive because rates are high, very high, and defaults, of course, higher than in Europe, but not so high.
Interesting. Just out of curiosity, you didn't mention Asia at all.
No, we are very cautious, meaning that you mentioned real estate. We do not do real estate loans. I think that when you do small loans, the collateral is something that needs to be addressed very carefully, because when you have a collateral with a loan, you have to assess the value of the collateral. Mm-hmm. You have to seize it if there is any default. You have to manage it, and you have to sell it. So you can imagine, for example, for auto loans or for mortgages in the US, this is something which is not so simple, in particular when there is a recession. Because when there is a recession, I mean, the surge of defaults makes it that the servicing companies, they can't handle all that problems and all that defaults. So that's why we do not invest in these areas. Regarding Asia, I think, again, we are very cautious. We do not invest in emerging markets in Asia, even if I strongly believe that there are a lot of opportunities there. But, you know, we really try to be the safest as possible. So we focus on really developed countries where we have a very clear legal framework, where we can handle all the tax issues and everything. And if you look at, you know, even very interesting places or countries, it may be a challenge. And we do not feel comfortable in adding those risks in the existing vehicle. Maybe, I mean, in a couple of years, or may then change our mind and have a dedicated vehicle for those kind of investment, but not on Moonstone, which is supposed to be a fixed income with a low risk and significant return.
Interesting. So if you could imagine three main differences between the European and the American market, what would, in terms of marketplace lending, what would be these three main differences?
Of course, the first one is size. The market, the US market, is huge in comparison with the European market. I think there is the culture of disintermediation is much more in advance in the US. I mean, even before the start of Prosper or Lending Club, there was already, in particular for small business loans, already some kind of disintermediation. So the culture of disintermediation is there. So that's one difference with the size. Again, another difference is that Europe is a highly fragmented market, with every country having its own legal framework, its own competition, its own lending habits. So this is very funny, but because we invest actively with 7 platforms in the US, 2 are with portfolio in a runoff, and we invest with 12 in Europe. And Europe only represents 10% of our investment. So that shows clearly that it's a more challenging investment universe, and it takes more time to identify the good platforms and to build a portfolio in a country.
So true, so true.
And the third difference is probably also a question of size. I mean, in Europe we have less data, and there are a lot of early stage platforms with a thin track record, even if they are sometimes in very interesting niches, and therefore it's very difficult for us to find the right partners, as this lack of track record makes it more uncertain. So that's why we try to partner with European platforms in different ways than in the US, you know, where we buy loans very rapidly and we can analyze them and track the performance. So it's more complex in Europe. But that doesn't mean that Europe is not an interesting market. There are a lot of opportunities there.
So true, so true. So you guys invest in, you said, 9 platforms in the US, 12 in Europe. How do you choose which platform to work with?
It's not an easy work.
I know.
I've seen during the last 7 years, I think I've seen roughly 150 platforms. So it's not an easy process, but in-depth due diligence is very important. It takes time, but it is key to a successful investment. You know, do not forget that when you purchase loans, you are not an equity investor, you are a debt investor. equity investors may need to rush, to catch opportunities. But lenders want to avoid or limit losses. And as I am an ex-market maker in options, I like to compare lending as selling out of the money puts. And my job is to have, for those puts, a strike that is the most out of the money. And this is done in selecting the right platform and the right loans. And finding those platforms is, of course, a question of getting data, getting information, it's networking. So in the US, it's not so complicated to identify and find the big platforms. There are not so many, especially for consumer loans. And they have a lot of track records, so it's not so complicated also to analyze. It may be more complicated to get access to them and to get access to volume, especially currently, because there is more demand than in April last year, obviously. In Europe, again, it's a question also of networking. We work closely with ventures fund, because as equity investors, they also, may identify interesting platform, interesting new business model, and we may be the one that could provide, the financing to originate loans and accelerate their business.
Interesting. We spoke a little bit about the European, the US market. How do you imagine the future landscape of general marketplace lending?
For sure, it's a rapidly changing landscape as competition is everywhere, both between platforms and between banks and platforms. Look at what happens during the last weeks in buy now, pay later, which is really a very hot place. We identified it as an interesting place to invest in and started a relationship with a French platform as early as October last year. But it took us more than 6 months to build the right organization, the right vehicle in order to invest with them. But in mainstream markets, and I mean by mainstream markets, traditional consumer and small business loans, the competition is the highest, and it will be more and more difficult to extract value. I think some players may disappear, especially in Europe, because they will be unable to bring sufficient returns to investors, and because also they will not be able to reach the size to be profitable. In the US, I think it's different because rates have always been much higher, providing a high safety margin to lenders. Nevertheless, platforms need to reinvent themselves, especially to market additional products to their clients in order to extract more value from them. And this is why you see platforms adding banking services, like credit cards or remittance services, etc. The one thing is sure, the original peer-to-peer model with pick and choose doesn't work anymore. As it doesn't secure funding for the platforms on one side, and also individual selections implies high ranges of performances with winners and losers within investors. And we started, in doing pick and choose with Learning Club and Prosper. And of course, if you are smart, you can really achieve higher returns than the average return. But on the other side, the loans that are not purchased by us may then, or by others with a good scoring model, are purchased by other investors. And then the range of performance is wide. And the platforms really don't want that. So that's why we rapidly identified that there was a risk in relying only on a pick and choose approach.
I see. Just to give a bit of perspective to everyone, today we are recording this podcast on October 8th, 2021. At least here in Switzerland, we feel that COVID crisis is somehow behind us, not 100%, but we would like to have that feeling. I mean, how do you see that this current crisis affected the industry in general, marketplace lending industry? Positive, negative? How do you see the future? How did it?
I think that the COVID crisis highlighted one of the big weaknesses of the business model for marketplace lending platform, the volatility of funding.
Yes.
And really, in a matter of days, platforms like Upstart, Prosper, Lending Club lost 90% of their funding. So it's difficult to run a company where you lose in such a short period of time a big part of your revenues. Of course, because of what I mentioned, I mean, the aggressive monetary politic from the US, it didn't last very long. But I mean, in a normal recession, we may have had a longer period of really very, very low volumes. And therefore, it endangers the business model of, let's say, pure peer-to-peer or marketplace lending platform. So I think everyone learned about it and understood, especially that's why you see, Upgrade being a neobank, some others adding, other services and also trying to secure their funding. I mean, one way is to diversify the sources of funding. Another way is to start balance sheet lending. But that's, I think, one of the important lessons from important outcome from the COVID-19 crisis.
I see. I mean, now if you look at it from an institutional investor perspective, and there are a lot of asset classes out there, why investing in this asset class? Why investing in marketplace lending? What are the main advantages you see there?
I think it's clearly risk return because risk is very low thanks to diversification and also because loans are amortizing, and returns should be LIBOR plus, let's say, 400 to 500 basis points, which is really significant in the current interest rate environment. I mean, it's much higher than high yield with a, let's say, a B or triple C rating. So it's net, and when I mentioned LIBOR plus 400 and 500, it's net of defaults and fees. Of course, without leverage, you may be able to do more with leverage, but without leverage, I think it's an astonishing return. Of course, this is only possible if the portfolio is very granular. So when I say very granular, it's with a very high diversification. And therefore, there is no idiosyncratic risk. And also regular cash flows with amortizing loans. As an example, none of the consumer loans we hold represents more than 1 basis point of our AUM. So even, I mean, that's key. Yeah. And even for the SME loans, we limit to 10 basis points of single exposure. Of course, you need to be very disciplined in investing. You need to be able to handle tens of thousands of loans. And also, I think a key feature, especially for institutional investors, is that this return can be achieved with a low duration. In our case, the duration of our portfolio is 14 months. So it means that even if there are huge redemptions, our portfolio would self-liquidate. Let me give you some figures. In our case, if we stop reinvesting proceeds from the existing portfolio, we can accumulate in 6 months 33% of the AUM of the fund, and in 1 year 54%. So without liquidating, at a distressed price, any of our assets. And this is because we only invest in amortizing loans. And again, this is one of the reasons why we do not do real estate loans. Even if they are short dated, they are usually bullet loans.
Yeah.
So amortizing loans are much safer than bullet loans because each monthly payment is low. As an example, our average borrower pays $400 a month. And with a bullet loan, even a not very big bullet loan, you have to repay it at the end.
Yeah.
And in most of the cases, you have to refinance. And refinancing when there is a credit crunch may be a big issue. So again, that's why I think the risk return of these kind of portfolios, especially when the investment process is very disciplined with these features I mentioned, risk return is very interesting.
Very, very interesting. Another question that comes to my mind, with this big volume of loans that you guys are managing, how do you do that? Do you have a tool you're using, or did you develop your own technology to do that?
Yes, there are some tools in the market, but when we started, there was nothing.
Okay.
Of course, it's not a very complex asset. An amortizing loan is something you can easily modelize. Yeah, that's not like a complex credit derivative. Something I did in the past. And but so we developed our own tools. Yes, our tools enables us to do our internal reporting for the investment committee, stress testing, risk analysis, cash flow analysis, scenario analysis. So it's, of course, it's an investment, and but it makes sense for us because we need to have that information day to day and follow our portfolio. So
amazing. With all these insights, Erich, I could ask like 1,000 other questions, but I think there is one question that everyone is curious to know about, which is, what is your favorite fruit, Erich?
It's difficult to answer.
I know, with all the other questions.
Kind of fruits. Probably I would choose, a very particular kind of strawberries, a Garriguette strawberries. This is one of these hybrid strawberries that have been, launched maybe 10 or 15 years ago. So they have a very good taste. So I like them very much.
Excellent. Thank you very much, Erich, for all these insights. It's truly amazing. Again, I could ask again and again more questions, but on behalf of our listeners, I would like to thank you for all these inputs. And anything else you want to add at the end? Or?
No, thank you very much. I was very happy to be your guest, and let's keep in touch.
Excellent. It's a pleasure. Thank you very much, Erich. Thank you, everyone who is listening to us. In case you have someone you think we should invite, please let us know. Don't hesitate to do that. Thank you, everyone. Take care. Goodbye.
Okay. Thank you. Bye.
I hope you enjoyed this episode. Thanks again for staying with us until the end. Make sure you subscribe to our podcast and follow us on social media so you never miss an episode. Please don't hesitate to send us your questions and comments at egregious.ch. Thank you.